Well, good morning, everybody. Welcome back to another webinar by the Everyday Growth Advisors webinar series that we do every Monday to keep you guys all in the loop of market conditions. This week's webinar is going to be a little more lengthy than usual. I'm going to be going through earnings projections for this coming week. It's a huge week, and I hope that you guys enjoy this video as much as I enjoy putting out this content for you guys. I want to find a little bit of time here to first go through the backdrop of the economy, a little bit through the economic projections and what we are likely to expect over the next coming weeks of this market. We are now currently trailing all-time highs on the S&P 500 and the NASDAQ, and we're not far off from going back up, surging back to the upside. Last week we accurately called out a pullback here to the first level of defense at the 4120, which is the level we were watching, and we got the bounce up and another forced double bottom on the Biden news of the tax implications after very strongly recovering on the next day. And this is primarily because I think market participants started to realize that negotiations with Congress would likely make any final tax increase lower or higher after negotiation. So I think all in all, from this situation, it's likely that the tax would be lower than what Biden has proposed, because there will be negotiations from both the Democrats and the Republicans on the same matter. Therefore, market participants quickly realize, oh, wait a minute, I don't think it's that bad of news. And so those little sell-offs that you get are really nice dips to buy to the upside. We didn't get the second retracement here, so I had closed out my puts on QQQ and SPY, and I am letting my VIX options for July run into the next month or so, just in an effort to curb any downside risk on the market. So continuing on from this, we also have definitely some key things to note, which are emerging market assets. I've been talking about China for a while, and just want to bring it to your attention that Chinese stocks are starting to make a little bit of a rebound. We've been mentioning about this because as the U.S. yields and they start to creep up, real rates start to go up. That actually makes emerging market local currency debt more attractive, driving ownership of U.S. assets as well as emerging market assets. And the Chinese stock market right now is severely oversold at this point. If you look at the daily chart here, you'll see we came down to test the key 200 EMA here, which has been a very, very key level of support through this market conditions. Of course, this market is generally very, very young, and it has still a lot of room for growth. A majority of these companies are very big leaders in their own sectors, and KWEB is one of the best ways to get exposure. If you want to also get exposure to mainland stocks within China, you can also go for ASHR, which tracks the top 300 mainland stocks within China, which also found a support at the 200 EMA, key level of support here, and we got a nice little bounce on the week before. So I have leaps on both of them, and I will be continuing to sell covered calls against my leaps to get additional capital to take to the upside. Okay, great. Other things that we need to continue to look at here in the macroeconomic standpoint. Labor market conditions are improving. We have job growth in the labor markets, which is a good thing. That was, by the economic numbers that have been coming out the past few weeks, and this is supporting the household consumption. We also have initial jobless showing pretty good recovery based on the financials that we are seeing. Banks also performing better through the earnings season, showing that people are actually spending, and then they also unlocked a bit of reserves. Main banks like JP Morgan and Goldman Sachs doing pretty well during the previous earnings report, and seeing considerable upside here till the rates are revised to the downside. So we see a very big run up in financials, and we are at the top of the cycle here with financials. So I wouldn't necessarily buy into these financials right now. They are slightly overbought. Okay. Of course, the Fed is going to continue with its fiscal policy and monetary policy tailwinds, things that are going to continue to give it boost in the economy. That will probably, continue to give the government increased spending, which is what they need right now, stimulus, and the continued drive of the economy to the upside. Okay. Also, virus vaccinations going through and kind of improving situations, but then some setbacks with other emerging economies such as India are kind of creating some sorts of jitters in the market of possible reemergences of the COVID cases. So those are things that we got to look forward to. Those will be possible things that will cause the market to throw a fit. Okay, tax hikes are also on the table. If capital gains taxes are raised unreasonably, then we'll also see a possible corrective wave to the downside. Now, are we looking at like a 10% or whatever? We can't tell. But if we do, then we'll take that situation when it happens and behave accordingly. Okay, awesome. Not to mention, companies are posting pretty durable corporate profits in the first earnings season of the year. Majority of the S&P 500 companies are reporting better than expected profit growth. And even though we were expecting them to fail their first Q4 of 2020, majority of them actually had surprise beats, which was what contributed to this great level of confidence in the market. The S&P 500 PE ratio is now at 42.56, and the Cape Shiller PE ratio is at 37.56. The last time this happened, and we were above the 40s, we had a major correction in the market. I'm not saying that this has to happen again. We could easily have a temporary correction and then continue to the upside, but it's just important to note these things as they happen. Okay, great. So I want to take a majority of this time during this webinar to go through with you my expectations for this week. So first things first, kind of the sector rotations, things that we should be watching out. Here's the heat map from last week's performance of the market. You can see big tech generally performed pretty flat the whole of last week. Microsoft, Apple, Google, Facebook, Amazon, mainly flat. Even Netflix, after, as I was mentioning, they need good guidance and they didn't provide good guidance. As I mentioned, you could have a stellar earnings report, but then no guidance means we're going to see a market projection of weakness. And so therefore, Netflix got projected as weak. If you are a Netflix believer, a long-term believer of Netflix, you will find this opportunity as a good opportunity to buy the dip, right? So stocks to watch this week are going to be the big tech, which are going to be all reporting earnings this week, including Tesla. And then also semiconductors, which have been performing worse than the broader market this week. Okay. Another sector that I'm looking at for possible rotation into is energy, as I continue to be bullish on energy stocks and energy exploration, so oil exploration and energy in general, as OPEC Plus continues to hold prices at the current levels through controlled production. As I've mentioned before, they should outperform the broader market as businesses and flights open back up, as petroleum and kerosene are byproducts of crude, and that will directly correlate with broader market performance in the energy sector. Okay, industrials have so far been a very mixed bag last week, and majority of the market has been actually rewarding value stocks such as Walmart, Costco, Coca-Cola, Pepsi, PG, Triple M, etc., etc. So those are the main watches for me this week as we're heading into a very heavy earnings season. Very, very heavy. So let's get some perspective here, and I'm going to run through my expectations for certain stocks. The first one on the list is going to be Tesla, as they're reporting earnings Monday after the market open. We've been seeing a decent pullback on Tesla here. This company has reported the past 3 reports on earnings have been positive beats. They've topped revenue expectations and they were profitable. And I think that we may want to take a coin flip bullish trade here to the upside. There's a heavy possibility that Tesla continues to beat its earnings and continue to deliver. Remember that we had pre-released the Q1 deliveries as well, which were better than expected, which may result to better performance on the stock to the upside. It is trading in a very, very symmetrical pennant right now, which may see the stock pop to the upside on earnings, which will be reporting after market today. So when you watch this webinar, you will already see it. Now, projections here, I think taking a debit spread, coin flip bullish trade where you can mitigate the upside, buy a call, but then also fund that call by selling a call that is a higher strike, will definitely give you the risk-defined approach to take this to the upside. My recommendation would be something like the 750, 760 debit spread. which would give you a nice upside here. And if the Tesla beats, it has a expected projected move of about 9.6%, which is going to be a 10% increase. And playing the weekly option there would be pretty cheap. I would say going to cost you maybe a couple $100, and I think would be a good idea there. Next up, I want to talk about is JetBlue, which is also reporting Tuesday before the market opens. This is another one that has been trading sideways through this period, but it has been bullish. Has been pretty bullish here. If you can see, this has been trading pretty much in a kind of a uptrend, and forming also kind of a pennant in some degree. Okay, so this is another one that I'm watching for earnings, a bullish possible trade. The mentions for growth here are pretty substantial. They have, however, the only downside of this trade would be the potential of bad guidance, and then the stock has not recovered its COVID losses, as well as these companies, airline companies in general, during the COVID crisis have diluted their earnings. They have diluted their stock by a lot, and so that kind of reduces the ROE for equity holders, and kind of creates a not such a beneficial performance. But this to the upside makes sense. 6.8% is the expected move, so I would go, somewhere between maybe 3 to 5% on either side. If you want to do a debit spread to the upside, that makes sense as well. Taking like a 21, 22 debit spread, something cheap, out the money, that would make sense. I think, for earnings, you really don't want to bet on naked call options. I think playing debit spreads is definitely a way to go. It's much more better as a situation to just cap your gains. If you are planning to take just a naked call, remember you're going to lose all of it. You can use the sold call to fund part of that, and you still only risk what is the debit. So in a debit option spread, you can only lose what you put in. It's the same as buying a naked option, except for it's cheaper. You just capped your upside now. So if you hit it, you hit it like a 21, 22 debit spread here. If JBLUE, exceeds 21 by Friday, and moves to the upside above 21, you cap your earnings, but then you're able to keep it this risk defined. Okay. UPS here, very bullish here, consolidating above the resistance here. Looks like insiders have been spiking for this position for a while. We saw a very big move here this past week or so, almost a 14% move on UPS, signaling that I'm pretty sure insiders or institutions know something here. I think that this is a high probability bullish spread. You can see that a lot of spiked buying happened throughout this week, and it has been pushing the price higher and higher. Demand is down year over year, but then the stock is trading at an all-time high level, and it has performed extremely well in this past 1 year. If you look at it, this stock has been performing beautifully this past year. Just kind of consolidating and moving higher. This stock faces considerable threat from Amazon, but I think since it's reporting before Amazon, it will be a good little promising bullish trade to take for the earnings. The expected move for UPS is 4.2%, or about $7. And once again, I think a debit spread here makes most sense. Okay. The next company is CROCS, which I want to cover. And CROCS has been trading range bound here after the COVID crisis occurred. Has moved up significantly, and I think is now at a overbought phase. So this stock has actually performed extremely strongly since last year, and is now kind of showing slowing demand growth. And I think that the earnings last quarter, it kind of gapped down and moved further down. I think I'm expecting the same thing this quarter. As it's back to all-time high here, it seems like market makers bought this up entirely just to short this stock. And so I think, if anything, one thing that we have to be careful about, though, is CROCS has been a very actively bought stock this entire pandemic period because of the increased use of medical profession workers buying CROCS and using them in the field of hospitals, etc., etc. So that's one of the things we've got to look at. But I think I'm more bearish than I'm bullish on this. The risk to reward ratio, more importantly, favors the downside here. And so I think I'm more bearish than this. It's different from UPS, which has been trading on all-time high. But then I have been bullish on UPS because of its continued economic moat, which it has. It's a very, very deep network of deliveries and stuff like that. Next is Pinterest. This is, in my opinion, a high probability bullish a bullish play for earnings. This stock has been performing extremely well. Very good revenue beats. The last earnings saw it also move further up before selling off irrationally. This historical support has been, somewhere around the 75 or so level here. I want to say below the 75 level. I'm sorry, between the 60 and 70 level here, and the resistance has been somewhere up in the 80 to 75 level here. So definitely a good chance of a higher high. It has been performing in a very nice little pennant here. I'm not sure if you can see this. Let me just draw it in for you guys. Let's put this out here, and you'll see what I mean. Boom, 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 right there. So it's been kind of consolidating here in this little nice pennant here. And I think I expect to move up to the upside here. Pinterest has a 10% implied move, which means it would see the stock move about $7 to $8 to the upside. Debit spread here makes sense once again. $7 plus 75 will give you an $82 expectation, but I don't think you should do the 80. Maybe a 80, 85 debit spread would make sense. You could even go for the 70, maybe the 75, 80 if you really want to be in the money with the debit spread. The weekly expiry makes sense. I don't think it would be that expensive. And that's Pinterest. Next up on the cake is Google. Oops. And Google here looks very overbought. Falling wedge broke out, consolidating above here. I think it's gonna definitely beat earnings, but then I feel like the guidance might be a problem for this company. This is a huge company that's trading at a very high valuation, which is, I think, fairly valued at this point. I think that it has room to run, and I think that this week it could run to the upside, but I think if it runs further, I would be inclined to take a bearish position after earnings. This is my play on Google. I'm not going to play it for earnings, but I think after earnings would be a good time to short this stock. Next one is Microsoft. And, this one also has run up quite a fair bit. I sold some 265 calls on this one, I think on Friday, and I will be looking to cash those out sometime this week. I think that right now they have very high expectations on Microsoft, and it has been beating earnings and outperforming the market for a very long time. But I think it needs a correction down. And that might be one of the things that will, cause this to move. It's only going to move about 4%. This one implied move is about 4%. So don't put your expectations too high. I would say don't trade this one for earnings. In my opinion, it's not worth it. 4% move is not really going to make a big, justification here. Next one up is going to be Spotify, which is going to be releasing earnings as well this week on Wednesday before the market opens. So I've just taken notes, and I'm kind of giving you guys my lowdown on what I'm expecting for all of these. This one looks bearish right now, and I think the continued bearish momentum is gonna continue with this one. It seems like even on the last earnings result, it kind of gapped down and kind of performed below the investors' expectations, and kind of had a fake bull trap here, and then came crashing all the way down after that. This one has demand pulling back from last year's all-time high level, and definitely has a lot of bearish price action in the recent past months. It has been really struggling to meet profitability, and that's one of the things that I'm kind of mainly looking at with Spotify here. The podcasting stuff and all that hasn't really been taking off that much if you think about it. Reading into the earnings reports and stuff. So I made a whole list of things to note about all of these. I think this is a stock that you want to remain bullish in the longer term, but then for this earnings period, I feel more bearish than I do feel bullish. It has a 7% implied move, which is a nice little move, and I think this might be a possible one for a possible strangle, if you will. 7% for like you're talking about a $20 move. You could buy two out the money options, out the money call and an out the money put at the same time. Do a little strangle. It's going to cost you a little bit of money, and might be a good little bagger if you get a big move on this one. Next one's going to be Shopify. This one's also at a 7% move, and I think the mentions and the demand growth for this stock has been also kind of mellowing down a little bit. It recently turned bearish after making a lower high here, and I think that trend may continue for the next few weeks before it sees some upside. I am, however, bullish on this stock long term. It's sitting on its intrinsic valuation right now, which is what we valued this business back in December. As you can see here, I never take these valuations off this the charts here. So you know, majority of my valuations stay on here. Sitting on the valuation, has been really using this valuation as a very, very strong level of support. I personally am going to avoid playing this one for earnings, but if you want to play it, I recommend a strangle once again. 7% move makes sense for a possible strangle, and I think might be a good one for a up and down play. Next one, Grubhub. This one has a 9% move. Okay, implied move is 9%, so we're expecting a volatile earnings season with this one. And it's supposed to be acquired, I think, by the end of 2021, I think by Uber, right? I think that's what it was. The acquisition was meant to be made by Uber or something. 9% move makes sense to possibly do a straddle. You could buy a call and a put at the money and let that one ride and see you know, which one hits. Possible 9% move makes sense for that. Or if you want to, you know, be cheap, you can just do a strangle. Easier. Just buy the out the money call and put, and that'll be much cheaper, in my opinion. This one's trading right between the all-time high and the recent support here, so I think this is a good one to play a strangle on, personally. I think you can avoid it if you want as well. That's another thing that I would talk about here. Okay, another one that has a very big implied move is OSTK. This one has a 13% implied move, and I think it warrants a possible a strangle or a straddle. I like high movers because you know, you could bet on either side and you will win if you bet the earnings. But this company has had slowing demand, and it has extremely volatile earning moves. Do you see? The last time this thing reported earnings, it sold down like crazy, and even this time right here, boom, came really, really hard down, and even this time right here went up really hard. So it has very volatile earnings periods for the past 3, and I don't think this one's going to be any different. I think this is going to be a very volatile earnings period for it, and I think this is a good candidate for a strangle or a straddle, whichever way you want to play it. Choose those out the money strikes if you want to know how to choose them. You know, you can go by the beta and then correlate the beta data with your options chain. See what's the implied move based on the options chain, which is this for this particular one is 13% for the stock move. So you're looking at about a $10 move here, which is a lot. Okay, it's a lot. So that's another one that I think might be good for a strangle slash straddle. eBay, another one that's reporting earnings. I think this one's setting up for a nice little bearish move. It's you know, got rejected double top here, seeing 3 really nice bearish candles here, and I think it's setting up for a kind of a gap down. E-commerce name has pretty much failed to, you know, get out of this resistance twice now. I think taking this to the downside is a good play. Do a put bearish debit spread, makes sense, right? Maybe buy something like a 50, let's see, the implied move here is about 5%, so you're looking at about a $3 move. Depending on where it trades all the way, it's reporting Wednesday after the market, so let's just say, you know, a $3 move down from here would be 58, right? But then we don't know if it's actually going to move that much, so 58, you might want to buy the 58 put, and then use maybe the 56 put to fund the 58 put. So giving you a cheaper put altogether. I think that's a good way to do that one. Next one, Facebook. I have a feeling Facebook will beat earnings, but it's in a bull flag that has been looking extremely bearish, and I'm not really sure what to make out of this, but it's been extremely bearish, and Mark Zuckerberg has been selling a lot of his shares. I've been covering this on the live stream. I feel like, you know, there might be a move down coming from Facebook, but I can't be sure. I think they might beat earnings but give out bad guidance, which will be extremely crucial for this stock. They need good guidance. You know, it's not enough for Facebook to beat earnings here. I think that I mean, I use a lot of Facebook ads, and I use their services, but I don't know if a lot of businesses would have this past quarter. And they tend to always underperform the quarters. All earnings, majority of them at least, see the stock getting sold off really, really hard, except for this one right here. I'm more inclined to bet this to the downside than I am for earnings season. Apple is the next one. And I think that Apple's earnings season has already been priced in at this point. I think playing this to the upside for earnings might be a bad play at this point. I think that it's going to be very difficult to manage the market expectations here. And I really just want to play the run up to the 137, 138 for this week, and then cash out whatever Apple positions that I have. This one's going to have an implied move of 4.7. By the way, Facebook was an implied move of about 5%. And this one really needs, a lot of good, strong guidance to perform better. And Apple just hasn't showed that strength lately. With the release of new products, the mentions have been pretty poor. And, I don't want to say anything else, but I don't think it's going to really beat earnings that well. But I'm probably going to be wrong on this. Apple always surprises. Amazon failed to break out of the 3-4-4 I think that their increased cost of goods sold are going to be significant headwinds. Remember that this is mainly the thing that we investors are going to be looking for on their report. How is their COGS looking, and how is AWS looking in terms of the entire performance of the ecosystem? Shopify has been a major contender also. And above 3,500 plus is, we rally up there at 3,500. I'm gonna very comfortably take a short position on Amazon for the short term. Long term, I'm very bullish on this stock. Implied move with Amazon's 4%, by the way. Okay, and then there's a lot more, but I'm just gonna do this last one is CROCS. Actually, hold up, maybe not CROCS. Let's do Blue Apron. I've been talking about this one on the live stream. And APRN, I spoke about how this one spiked up during the pandemic, and now it's starting to release its steam and gone bearish. And I think investors are starting to price in that this stock is going to actually underperform earnings. And look at what happens. Every earnings season, this stock dips like crazy. It's insane. Okay, look at this. Look at this. Insane, all right? So even here, look, it has a history of not beating earnings. Okay, and I think that this quarter is not going to be any different. I think that this company is probably going to fail earnings, and now that the pandemic is starting to open up, they're going to have bad guidance too. Bad guidance, bad revenue, bad EPS. Boom. This one's easy short position in my opinion, but don't go balls deep on it. This is a good one to just take a light bearish position and have it pay. Implied move is about 16%. So you're looking at a $1 move. I think this one you can just short outright with the put and take your money and run. That's in my opinion a good one right there. Okay, that's it. That's all I wanted to give you guys my kind of expectations of this week. And I'll put this on Instagram for you guys to view as a IG story as well, so that you guys get a good idea. And I'll see you guys next week on the webinar, as well as tonight for the live stream. We're going to be covering AT&T, and I'm looking forward to seeing you there. So have a great day, guys, and I'll hope that you guys make some profits this week. If not, I say this is a great week to just entirely sit out of the market. Let the market figure itself out, and then come back next week, and then just smile and have all your money to spend on stocks that are oversold or overbought. Cool. Well, have a good one, and I'll see you again. Bye.